There's nothing normal about what you're seeing when it comes to this stock right now.
In January 2021, a well-known struggling company dominated the headlines, not for its business model, but for the meteoric rise of its stock price. GameStop started the year trading around $19 a share. Yet, by the end of January, shares were trading at over $300, at one point hitting a high of $483. Experts raced to explain what happened. The media settled on a David and Goliath narrative, pitting a band of individual traders against Wall Street hedge funds that were betting against GameStop's success. The GameStop phenomenon raised concerns regarding equity markets from just about every angle imaginable. It spawned hearings by the House Financial Services Committee, the Senate Banking Committee, as well as a host of investigations by the SEC, FINRA, and state securities regulators. Two questions are at the core of all these inquiries. Are retail traders hurting the market? And are retail traders hurting themselves? In this video, we argue that the answer to both questions is no. Retail traders are not hurting the markets or themselves. In fact, increased retail participation in equity markets should be encouraged, not further restricted. Retail participation in equity markets has been growing for decades, but the trend accelerated during the pandemic. Most commentators pin the acceleration to the availability of zero-commission trading, where traders do not pay an upfront commission to trade. But there were likely several other contributing factors in 2020. App-based trading platforms with easy-to-use interfaces began to proliferate, including apps launched by legacy brokerages. Many brokers began allowing traders to open accounts with minimal or no account balance requirements. Fractional share trading, which permits traders to buy a portion of a stock less than one share, became increasingly available. The pandemic, which forced people to stay at home and closed a lot of traditional entertainment and income options, also played a role. The momentum of these developments has led to a year-over-year growth in retail trading that continues to this day, helped by market insight platforms like Tradefluence, where retail traders can access actionable market insights from financial influencers with verified track records of performance. Over a year after the GameStop phenomenon, retail traders have proven to be not just important participants in equity markets, but beneficial ones. Ironically, their biggest assets are the things they're most often derided for by their critics. The fact that retail traders behave differently from institutional traders and each other is valuable in times of market stress. Where institutional liquidity dries up, retail trading can help to lower bid-ask spreads and dampen the price impact of trades. In fact, retail traders may have been a market-stabilizing force during the pandemic-induced market crash by holding their investments and buying when stock prices dipped. Greater risk tolerance, a feature often criticized when talking about retail traders, is necessary to fund innovation and entrepreneurship. It is no coincidence that the following companies are some of the most traded stocks on Robinhood this year: Tesla, an EV innovator; Sundial Growers, a bud trailblazer; Riot, a crypto powerhouse; and Roblox, an early metaverse adopter. Investing in the stock market is an important path to wealth for the traders themselves. While stocks do not always go up, the average annual return for the S&P 500 over the past 60 years has been approximately 8%. This is far and away above returns of many other investment vehicles available to individual investors, giving traders opportunities to grow wealth through trading. Even more so if they're skilled and have access to reliable market insights. Most acknowledge the benefits of broader retail access to equity markets, but some commentators attempt to justify further regulation by pointing to what they see as reckless, uninformed, or otherwise harmful retail trading behavior. Retail traders, especially millennials, have been derided as speculators who bring little value to the markets and will incur significant losses. This narrative undoubtedly applies to some retail traders, just as it applies to some experienced and institutional traders. But there is reason to believe that a lot of these young retail traders are not so easily categorized. For example, retail traders received praise for identifying the market bottom in March 2020 and generating better returns than some hedge funds through the same volatile period. New retail traders are also characterized as being persuaded by poor quality information, but research suggests that insights available through social media cannot be painted with such broad strokes. With respect to the Reddit Wall Street Bets forum, researchers have rejected the conventional view that the forum attracts only uninformed analysts and dumb money retail traders. Instead, their research concluded that many influencers providing insights on the forum are skilled, and where the quality of their insights could be discerned, were likely to benefit retail traders who followed their recommendations. Indeed, one of the most criticized retail investor trends from early in the pandemic, piling into besieged companies, has proven less off-base than depicted. Retail traders heavily bought Hertz in 2020, even though it had declared bankruptcy. Seeing the investor interest, Hertz sought to issue shares, but stopped the plan after the SEC got involved. Investor protection advocates praised the SEC at the time. Now, in hindsight, it's clear the retail traders had it right all along. But instead of gains for retail traders, the value went to the hedge funds backing the company's bankruptcy exit. It turns out, retail traders did not need the SEC to save them from themselves. Finally, some have called for regulation of social media, ostensibly to prevent mob-like retail trader behavior or to prevent the spread of misinformation. There have been few specific proposals, but restrictions on sharing of information are more likely to harm than help markets. Moreover, the specific regulation of internet financial speech unfairly singles out retail traders who are engaging in similar behavior to their professional counterparts. Platforms like Reddit and Tradefluence, for example, serve as a place where individual traders can share information and investment ideas. Professional traders, on the other hand, access research reports and investment conferences, making it more acceptable for hedge funds to share investment views than Redditors and Tradefluencers rightly would add to the view that the markets are unfair for retail traders. The GameStop phenomenon has focused a lot of attention on equity markets, particularly in how retail traders participate. Innovation in the retail investing space has made it easy to say that there has never been a better time to be a retail investor. Low-cost investment products like index funds and ETF have been joined by low-cost access to the market itself in the form of zero-commission trading, fractional share trading, and low account minimums. The psychic cost of participation has fallen too, as traders now have access to a plethora of verified market insights, like those on Tradefluence, in the palm of their hands, right alongside their brokerage apps. Not surprisingly, more traders are trying their hand at investing. Reintroducing undue barriers to participation that have been removed or introducing new restrictions has the potential to undo the benefits of wider retail participation in our equity markets. Opportunities for individuals to grow their own wealth should be welcomed and expanded, not restricted.